it's really important to have unit layouts dialed, because if you have a unit that is functionally obsolete day one, you're never going to reach that full market rent that you could possibly get for that unit.
What's up, Colorado? Welcome to our deal analysis show. So we're going to do a deep dive on a development opportunity here in a great location in Denver. Got my co-host, Matt Amundson. Hey, Matt, how are you?
Hey, I'm excited to be here and excited to hear what Adam Fenton's cooking up with this deal on 1000 South Logan Street.
Yeah, what's up, Adam?
Hey, good afternoon. How are you guys?
Doing great. So we recorded a podcast with you recently, kind of tells your story, the 30,000-foot vision and view of where we take a Narrate. And now this deep dive, we're in the trenches. We're at ground zero. And you're going to walk us through how you found this property, how you developed it, the numbers, help us understand everything behind the scenes.
Yeah.
So we'll be talking numbers, but this is a great one to also watch on video or go to the blog post for some screenshots.
Yeah, love this. This is not a hypothetical deal. This is something that you guys purchased. So
we own it.
I guess a good place to start is, how did you find the land? How did you get this project started?
Yeah, it's a great question. I think being just kind of high level overall, being in development and people understand that you're in development, you're always getting different opportunities your way, from whether it be a broker or someone's mom owns a property and doesn't know what to do with it. So we see just being in the space and executing on deals and building deals. We do see a ton of opportunities out there in the marketplace. This one specifically was brought to us almost 2 years ago, and really liked the project, liked the location. We have two other projects that we've completed in the Platt Park neighborhood, so literally within less than a quarter mile away. So we know this area very well, and very intrigued by it. There's 20 existing units on the site right now that were built in the 1960s, so it's a true covered land place. So we're making cash flow while we're going through our entitlement process here. But quite frankly, the asking value was just too high. And so we just kind of kept hanging around the rim. And, we put in this offer probably 3 or 4 months before we actually got it under contract. And we just said, hey, here's the price that works for us. We think your price is too high. But if you're interested in selling, this is where we can be. And, one Friday afternoon in October, I got a call from our broker on the that was working on our behalf on this deal, and said, hey, I think there's some distress here. I think seller really wants to sell it. I think if you can take your offer up $100,000 from $4 million to $4.1 million, think there could be a deal here. So we said, okay, thinking there probably wasn't much there, because we were pretty off on where what they wanted as the purchase price.
Do you remember where they started originally?
This thing 2 years ago started in the sixes.
Okay.
I think it was just over 6 million, like 6.5 million maybe.
Wow.
And we ended up buying it for $4.1 million was the land purchase here.
There you go. I think I hear, a common thread is patience and acquisition.
Patience. Yep.
Stick to your numbers.
Yep. That's it. Right.
Make it classic. You make your money on the buy.
Yep. That's exactly right. We are in a position where we don't have to do deals just to do deals. We will only do deals if we are firm believers in them and think there is upside, and what our kind of investment thesis is really just hit a double every time. If we can hit a double, hopefully every once in a while you hit a home run or a grand slam, and then there's going to be some singles in there, and just avoid the strikeouts.
There you go.
So that's kind of very, very high level kind of what our thought process is here.
Well, cool. Well, we're going to start in with the investment memorandum you've got here. So just kind of give us some highlights now that you got the land acquired.
Yep. Yeah. So once we acquire, in order to acquire the land, we do, Narrate puts our own money in, but we also, this was a deal where we didn't have a long time frame where we could essentially go through entitlements while we have the property under contract. We had to close the property before we really knew what exactly we can build here, and we're actually kind of going through that design process right now. But you do enough research and just looking at numbers and talking with the city and different stakeholders that we felt very comfortable that we could make sense of this asset. And as I mentioned as well, we have 2 projects across the street in the Platt Park neighborhood at 1250 South Pearl. It's called the Aston, and then 1190 South Penn, which is called Caraway. So they are the Caraway is 42 units. The Aston is 73 units. So we know this area and submarket really, really well. And both those buildings were completed last year. We stabilized them last year. And what essentially our business plan here was to take our most successful units at those 2 projects and do a new project now that we have all this information with those ideal unit plans.
You're talking about like the interior design of these units?
More so like size, layout, those things.
Okay.
So a little bit interesting. At our Aston project, the 73 units are large 1-bedrooms. So that'd be, I would quantify as 825 square feet to 950 square feet. We had
those are great size 1-bedrooms.
They're big ones, right? Some of them have dens. Those were the first stacks that leased, and they leased at our highest per square foot across the project.
There you go.
Which doesn't make intuitive sense of what you typically see. Typically, you see smaller units, higher per square foot. But this is a unique product type and a unique location. People here have money and they want really nice, well laid out units that have great interior design, and they're willing to pay for that.
There you go. I think it helps too. Then you have, like you say, the covered land play for people who aren't familiar with that term.
Yep.
That means that the existing building covers your costs. So it gives you time for your entitlements, get your plans together.
That's exactly right. Yep. So we bought this, in the past, it might've been a good buy on the cap rate, but on the existing, we bought it at about a 5 cap rate.
Yeah. Well, I was going to say, you bought it for, just over $4 million. I know you bought on there with a 20 unit apartment building. And that's just over $200,000 a door. Like that's market rate. It's probably a little bit less for that location.
Yeah. So that's also why we liked it is, we're always looking at risk and we're weighing our risks. And in here, you look at it and say, okay, we believe that development is the highest and best use for this site with the unit types that we are focused on. However, if for some reason something doesn't go according to plan, we have a fallback plan, and that is to, put money. We could put money into the existing units there, probably raise the rents a little bit. Yep. It's still going to be a good. It's not going to be a great return, but it's still going to be a good project.
Fall back to a base hit on this one. Worst case.
Yep, that's exactly right. Yeah. So that's that gave us a lot of comfort here.
Could you go to the pro forma on the existing property? I think it's like page 7 on the offering memorandum, because I think this is because even like in year 1 you're projecting a small positive cash flow, right?
Yep. Yeah, it is a small positive cash flow. I think the beauty of a covered land play like this is we can put debt on it. Right. The old days of getting land loans, those are gone, right? Banks are not going to give you a land loan anymore. The only way you can get, a loan for a property you're going to develop is it has to be a covered land play. So that allowed us, so we put, I think, a $2 million loan on here with Independent Financial on the acquisition, but this thing completely covers itself and just reduces even in today's market with rates higher. I think we're at a 7% interest rate here on this loan. It's still less expensive than equity would be. Mm-hmm. So that's essentially why we would we put a loan on here versus just buying this thing all equity, and we do buy all equity too, don't get me wrong, we do that as well, but this is true covered land play and allows us to kind of fall back, have a great fallback plan.
Yeah, it seems like using debt in this particular acquisition was a no-brainer.
Yeah. I think, debt can be a scary word sometimes. But I think when it's done in the right way with the right restraints, obviously it can really enhance project returns.
So talk about the location, because I know you are big on location. Yep. That's one of your either number one or one of your top factors, right?
It is a top factor for us.
Sounds like maybe number 1, number 2, and number 3.
Yeah, that's right. Yeah, location 1, location 2, location 3. Okay, yeah. No, it's this is a site that's located in Wash Park, basically at Logan and I-25, right by the Whole Foods over there. We love these little boutique sites. This is one of the things we talked about in the last podcast. This is something that I think we really excel at. We have big time development experience, and can bring that to some of these boutique projects. And what we're seeing and what we saw with the other two projects that we built across I-25 is we are handedly outperforming the market over there and our competitive set to a pretty vast, over 30%
in terms of like rents.
Yeah, in terms of rents. So that is, I think, a testament to the sites we pick. That is a testament to the design of the buildings that we have, and to the experience that we create within these buildings. We are, and I mentioned this last week, we are not the low cost guy, right? You won't see a lot of stucco in our buildings. You'll see a lot of brick, metal panel. You won't see a lot of different materials. You won't see a lot of goofy colors. We're pretty, I would say monochromatic a little bit in our design, but I think that stands the test of time.
Classic.
It's classic, right? It's classic. So in 10 years, this thing is still going to be a trophy asset.
Mm-hmm.
It's not going to trend itself out of style here. And that's something that no matter where the project is that we do, we like to, we usually take that sense of design. So I think with all those factors and knowing that this location, these are, when you look at the home prices in these neighborhoods, you're, well over $1 million in Wash Park. And you're probably over $1 million now in Platt Park too, because a lot of the Wash Park folks have gone over to Platt Park. So we tend to focus on these neighborhoods that an institutional guy would probably overlook, right? It's not downtown, it's not down south. So where, they want to be in the job, quote unquote, job centers. And there's a lot of great neighborhoods in Denver and other large cities that are often overlooked. Another reason is there's not large plots of land available over here. So there's high barriers to entry, which we really like. So we are able to come in and pick off what I consider A+ locations and build a little bit smaller projects that are extremely successful. And I actually really like kind of this building small thing. We do have larger projects as well, but this building small and what it does for the neighborhood and the character that it continues to build and create there, I think is phenomenal long term.
This is a little off topic here, but you mentioned a lot of the institutions, they want to be more like the job centers and obviously the core business districts are near there.
That's right.
Obviously with, how a lot of downtowns have seen a downward trend in population since COVID.
Yep.
Have they changed your economics on them? Because like for me as a landlord, as a person and landlord, I'm less interested in downtown Denver now than I was 5 years ago.
Yeah. There's a little bit of herd mentality when it comes to institutions, and they have boxes they have to check. And those are some of the, and I started my career at a large institution. So I kind of speak to it. It's just one of those things when a lot of these institutions they're not in the city, right? They're not in the city that they're investing, right? They're either sitting in New York or Chicago, or in my instance, I was in Des Moines, Iowa, right? We thought we were market experts in Denver. We didn't know shit about Denver, So I think that's an advantage that you have, right? Like it was always like, you got to be downtown or you got to be in the tech center. And, I think there's just huge opportunities in these great, little sub markets, like the Highlands or Wash Park, Platt Park in our sense. Rhino's kind of blown up, obviously. But, I think that's the benefit of developing local as well, as you really know the pockets and the demographics and the people that live in those pockets.
Yeah.
And you can do a project that's a little outside, maybe the institutional box that can be very successful.
As we kind of dive into the numbers here, walk us through like the timeline, if you could, from a high level.
Yep.
Because then you get project kicked off in December 2023, but just what's a general timeline like it here for a project like this and the major milestones?
Yeah. So we bought this site in December 2023. We're actively working on it right now. Actually, I had a call right before I came to this meeting with the city on this project. So I would say a deal of this size. So we're looking at a roughly 65 units here. We're still working on layouts and setbacks and zoning and all of those things here, which go into the process and the design. But from a very high level perspective, a project of this size should take roughly 12 months, give or take, to get it all the way, to a point where you can pull building permits and begin construction. There's all kinds of things that will go into that, that could shorten that time frame or lengthen that time frame. But generally speaking, that's been our experience. with the projects that we've worked on, you know, that are a little bit more smaller in nature, it's usually about 12 months. And you know, and that depends also if you're going to rezone versus not rezone. We typically do not rezone properties. So
is that due just like timeline or just like risk?
It's a risk thing for us. You know, you're kind of putting the fate of the project in, you know, because a lot of times when you're doing a rezone, right, the project, whatever you're paying for the project probably doesn't work under current zoning. Mm-hmm. So you're taking a risk you're taking a risk that for your project to be successful, you have to get the rezoning approved. I would never buy a project knowing that we have to go through a rezone for it to be successful. Mm-hmm. I would build that into the contract timelines where yes, we're spending money, but we don't have money at risk until we know we have the rezoning approved. So really when it comes to the development process, there's kind of two different paths that you have to go down. So one is going to be your site development plan. So that is the first thing in line. And that is with the city. And that's really all of making sure you're meeting all your zoning requirements from setbacks, ingress, egress. You have transportation, civil are all weighing in. They make sure that your building height is under the height it should be, number of stories. You know, there's transparency calculations that go into this on the ground level that they require.
What do you mean transparency?
You know, so
like window transparency?
Oh, yeah. So depending on what zone district you're in and what type of road you're facing, they have certain requirements for that. They have build to lines as well. So they don't want your building too far off of the property line, but they want it set back far enough. So that's kind of this process. Typically that would be probably 3 to 4 rounds of submittals on that.
How long does that usually take?
That's really, I would say that's a good 10-month process.
Okay.
So what they allow you to do is they allow you, so that's kind of the first step. And then once you have that approved, then you go into building permits. So that's the actual permit that allows you to build what you've built here. That's much quicker. And you can get a foundation permit and then a superstructure permit after that. So you can break it up. Like if you're going down 2 levels and then coming back up, you would probably bifurcate it because you can start your construction probably 3 to 4 months earlier. But what they do allow you to do, the city, they'll allow you to have the site development plan and building permits overlap. So basically, if your project coordinator at the city says, hey, we're far enough along down the path from a site development plan perspective, you can, even though we're not approved yet fully, you can go ahead and start submitting your building permit.
Well, you kind of alluded to, you're still working out some of the architectural design plans. So you're doing that while you're in SDP, right? Yep.
You're doing that. And you kind of want that. You almost have to have that figured out before SDP. So then there's a concept that will go in, and then there's formal. It's usually one, you'll probably have one concept, a second concept, get out of that, and then you're probably 3 to 4 submittals after that. Mm-hmm. So, and that's usually that process is usually led by your design consultants. And then we will also bring in, quote unquote expediter. So they're really kind of a liaison with the city, making sure that our stuff's getting reviewed and things like that. The one project I didn't use them on, it did not turn out very well, and the process took a really long time. So that's something that
they're a key team member.
They're a key team member. Yeah. There's a lot of different, within development, there's a lot of different members of the team that have some level of involvement. At the end of the day, it's almost like we're a quarterback, right? We're building teams and making sure that everyone is doing their job and trying to make decisions to allow everyone to do their job.
Yeah. And then you're December 2024 looking to break ground.
That's a little aggressive now. So I think, this was put together, back in October of last year. So just knowing with where some of our design stuff is at right now, we're getting into the nitty gritty of it. Nothing bad. It's just, I think this is probably realistic. Probably a Q1 start next year. So, call it, a little over 12 months. But it's got, the site has some interesting things going on with it. That it's not bad. It's just going to take a little bit of time to work through. And, the other thing we're doing right now is making sure that we get our unit mix and sizes, extremely dialed in. And that's really
so. How do you? I forget. I was looking at that earlier. So how do you, when you say dial in the unit mix?
Yep.
Is that just through like rent studies, or how do you know the right unit mix?
Yeah. So that's a great question. So I think a lot of it comes from just experience in the seat, to be honest with you.
Okay.
And there are consulting companies out there that can help you with this. But what I would say is, like, we knew going into this project really what we wanted it to be. So Chris, your question of having it dialed in, it is really looking at rents. But what we do is, we knew going into this project, we wanted large 1 bedrooms. That is kind of the bread and butter and the backbone of this project. And there'll be corners and, certain units that aren't going to meet that. But what we're literally in the process of doing it right now. We hired a drone company, and they went and shot drone shots from the first level, second level, third level, and then from all corners of the building as well. So what we have to make sure is, like, we've designed like our Mac Daddy unit that lays out great. Well, it's got a shitty alley view, right? That's not going to, that's not going to fly.
That is such a cool way to using the drone.
Yeah. So we literally, I was going through it last night. Literally I've got 2 screens up, and I've got, the unit here, and we haven't even really laid the units out, but it's just kind of size and rents, okay, what's an average rent for something like this going to be? It's like, okay, is someone willing to pay you $3,500 for this unit that looks in the alley? Well, probably not. So let's not put that unit there. That's not going to be successful, right? So that's when I say kind of dialing in unit mix, that's really just demising, right? Okay, we have a 1,200 square foot 2-bedroom here. We've got a 500 square foot studio here. It's really kind of laying those out in the right positions within the building. To make sure that it's kind of optimized at that point in time. And then as the design evolves, then we'll start getting into like true unit layout. So here's where the bedroom, bathroom, closets, kitchen, the flow of the unit, and I've been doing this for, 13 years now. So have a pretty good, I've seen them work really well, and I've seen them not work really well. And it's really important to have your unit layouts dialed, because if you have a unit that is functionally obsolete day one, you're never going to reach that full market rent that you could possibly get for that unit.
Could you walk us through the development budget? Because this is something I'm always fascinated, and especially like breaking down the hard costs, the soft costs, things like that, because to me, I like learning about this.
Yeah, sure thing. So, and I will say, the other thing on this is, we actually, and I can show it to you in our development pro forma when we go to that. But these, where you see your hard costs up here, and you see your soft costs down here, we actually take and break these categories down even further.
So the financing costs, the fees, the interest reserve, all that.
Yeah,
okay.
Yeah. So you'll see like architect of record, right? That sometimes can be made up of 4 or 5 different line items in it. So we've got probably, 150 different line items. So we try to get very detailed in how we track all of our costs. And this is just something that's come over time with repetition. So, when we're, there's a lot of costs that people don't think about, but are very real, that you do, they are part of the project. So you can't forget about them, because if you do, you can find yourself upside down pretty quick.
Yeah.
Right? So for example, power line relocation and transformers, right? If you've never developed before, you're probably not going to have that in your budget. It's a big deal. I've had projects where they'll go up to $1 million.
Because you have what, $100,000?
I've got $100,000 in here. Yeah. So, and that's one of those things we're working through with Excel right now. We've got power lines that are going to be right on our property, that sit right on our property line, that we have to bury. And we don't really have any way around it, because that's where the foundation of our building has to go. And you can't have any big rig within 10 feet of that power line when you're building it. So it'd be almost impossible to build this without moving those, right? So there's certain things like that, but from a very high level, here is, I can run through, very quickly every line item here. So land costs, this is just what we paid for the land.
So 4.1.
Yep, 4.1 million. Residential hard costs. So this is the hard cost. So we're going to hire a third-party general contractor to build this project for us. This right here, this 20.8 million, that is the preliminary feedback that we have received from general contractors for what our vision is going to cost. And this will continue updating this as we go through the development process, the pre-development process, because it's at every major category during the pre-development process. You're adding more details to the project at that point in time. So I think it's starting very high level from a concept all the way down to like very detailed construction drawings to, the flashing that goes into the window to the type of door handle you're going to have to, you name it, everything is detailed in the construction docs.
Because those two right there, that's 79% of the budget between land and the construction costs.
Yep. So as you can see, those are the huge parts of the project.
And since you guys are not that far through the planning and all that, like, do you take that build number that you get and pad that at all? Like, what's your
So we'll pad it. So there's 10% padding in this number here from the general contractor. So I think we had 3 guys look at this, and we kind of took an average of all 3. And then what we will do, we will pick a general contractor. Once we get through concept, we'll pick a general contractor to work through for the rest of the design. Because what we'll do is we'll sit there and say, okay, like this is our budget. Our budget is $20.8 million. And you general contractor need to be in this room as we're designing this project to make sure that our architects are not drawing stuff that are crazy, crazy expensive that you don't have in your budget. So that allows us to hopefully get through the pre-development timeframe in a much more efficient manner, right? So the 2 major things that you're working through in pre-development are your city stuff, right? Site development plan and building permits, and then the other side of it's going to be you have to make sure you have a project that is feasible at the end of the day.
Yeah.
And you need your general contractor sitting there by your side to help provide that guidance.
Oh, that makes complete sense. Get everyone in the same room, make sure everyone's on the same page.
Get everybody on the same page.
I have made that mistake many times in my career.
Yeah, well, you mess it up enough times, you finally get it right? But no, I think that is the best way to do it. And there are different, which we could get into in a completely different conversation, but there are different ways to structure your contract with the general contractor as well, where you could put more risk on them, but we have less control. So there's multiple different ways to kind of skin the cat when it comes to that. So kind of just going through here, I'll kind of hit up on these pretty quick. You got financing costs, right? These are the costs of getting the loan. So I'm assuming it's a 1% loan fee, development fee. This is a fee to, the development team here. That's really just, kind of that keeps the lights on, and we start taking that fee. We don't take that fee until we're under construction. And it's usually on a smaller project like this. And that is a construction management fee and a development fee. So that's kind of a 2-in-1 fee there. And that will usually range on a small project like this between 4 to 6% of overall project costs. As you start getting larger projects like over 100 to 150 units, usually that will dip down to more like 3. So interest reserve, you can see that's a big number, $1,054,000. That's the interest that we're going to incur on our construction loan while we're under construction and before we start cash flowing, right? So there'll be a time period once we're done with the project that we're in lease up mode that we're still having to pay the loan. So this is assumed to be an interest only loan on the project, but as you can see, a pretty large number nowadays.
Well, that's at 8% on here, right?
Yeah, and that's probably in today's market probably a little aggressive. Thought process is by the time that this thing comes around, hopefully we're starting to see things trickle back down. But we always we'll go into a project, right? So if we go into this project and interest rates are higher, then we'll bump that up.
Yep.
If they're trending lower, we'll always we'll bring it down a little bit. So that's the one thing I would say is throughout the pre-development process, everything's pretty fluid. There's a lot of moving parts of, hey, like we have a concept budget up here at 20.8 million, but it could be 19 million when it's all said and done because we got more efficient, better design, or it could be 21 million. A couple of years ago, we were seeing a lot of cost increases during this phase of the project. Even though we had our general contractor there, that was 2022, beginning of 2022, where we had a project where our hard costs went up almost 32% in 6 months, which can make things challenging.
That's when materials were
Yeah,
high.
materials are high, labor's high, and there was price gouging going on from subcontractors that we worked our way through it, and we're building the project right now. But there was a few sleepless nights in there,
Well, good thing I fixed that on those, right?
Yeah, yep, that's right.
You don't have to go through every single line on here. Really the pro forma. Is there anything to highlight? But like, I want to dig in the pro forma.
Yeah, I think we go to the pro forma, and we can, happy to answer questions, from you or any of our listeners at a later date. But, these are all pretty real costs. You'll see some big costs, small costs, and this covers everything and anything that you'll run into for the next, call it 2 to 3 years through pre-development and then ultimately building the project.
Mm-hmm. All right. So we got the spreadsheet pulled up, and you're going to do some real-time Excel wizardry with us.
That's right.
So Adam's got a lot on the screen here.
Yep.
Where my eyes are all over the place. What is going on in the spreadsheet, Adam?
Yep. So this is our development pro forma spreadsheets, and you can see down along the bottom here, we've got all kinds of different tabs. It seems overwhelming. It's pretty straightforward once you kind of get in here, and there's only so many things you can change in here that really, I think, change the returns of a project.
I love how he makes it sound so simple.
Yeah.
That's why we build these complex spreadsheets, right?
So we built this. We built this from scratch. This is Tanner Shulvin, who's on our team. This was probably a 6-month endeavor when we first started, and I said I want to build a new pro forma that is a little bit more simplified but has a lot of functionality. So this is really when we're starting to initially look at a deal. This is, before we ever even put a project under contract, we're putting this together, and then we continue to refine it over time.
Yeah.
When we get a project in the door, typically pretty quickly, I would say within a couple of minutes, we know if it's something worth pursuing or not. Just we've done so many deals. We know generally where rents are in certain areas of the city. We know once we know what the zoning is, we generally know, where our what we can build here, what our costs are going to be. And if I think there is something to it, I will send it. I work with Oz Architecture almost exclusively. And I'll send it to my guys over there and say, hey, here's this site. Could you do a quick massing for us? They'll put together within usually 2 to 3 days. It's very high level, but gives a general idea of density that we can get on the site. And you have to be careful. You can't, in multifamily, you can't just take a site and then like do the setbacks and just blow the balloon up, because you might have like 65-foot deep units, right? That's not feasible. So that's kind of the first step. We'll get that from the architect, which we can go through that in a different session as well. But once we have that from them, then we're dropping our numbers into this, to really know, hey, like this thing passed the smell test or this thing does not.
So getting the architects, that's part of the first layer sniff test?
That's one of the first layer sniff tests. Yeah. Because, we might get there and then they come back and say, well, you're next to a protected district, so you have to have a step, you have to have a step down on the alley, and one of the structures, it's contributing, so you can't tear it down. I just spent, nearly 9 months on a project that we're not going to be able to do because it's considered contributing. So we can never tear the building down, and you can't redevelop it. So those are some of the things that you kind of go through early on. But really, I'm going to start very high level. This is what we're focused on right here.
What numbers is that right there? So
I'm going to zoom in a little bit here on this.
Oh, I see my 3 favorite letters, IRR, as you zoom in on there.
Yep. So these are, on this one, I'm focused on the untrended return on cost, and I'm focused on our levered IRR.
Why those two?
Those are the measures of the return on a project. And I tend to focus more on the untrended return on cost than the levered IRR.
Untrended?
Untrended.
What does that
mean? Yeah. So when you get in development, you'll hear trended and untrended. So basically what that is, if it's an untrended return on cost, that is with today's rents, here is what that return on cost looks like. So some developers will trend that and try to make their numbers look better. right? So what they'll do,
forecasting rent growth.
yeah, so
over
they'll
a few
forecast
years, yeah.
rent growth over the next handful of years, the 2 to 3 years that it takes you to go through pre-development and then the construction, right? They're going to grow rents that whole time. So of course your return on cost is going to be higher. What we try to do is we try to say, hey, the rents that we are going to get when we start leasing this in 2 to 3 years are equivalent to the rents that we could get here if this was built today. So we really tried that. That is one risk mitigation thing we like to do, is not grow rents exponentially during that process, and especially in today's environment, right?
Yeah.
With, we don't know, rents could go down.
Yeah.
So we think that's a good middle ground. Maybe it's, in a good market, it's conservative. No question, but we like to tend to stay on more on that side of it. So, yeah. So so return on cost, right? So let me, and I do focus on levered IRR, but I'll just do one quick sensitivity to show you how you can manipulate an IRR to kind of read whatever you want.
Because your favorite metric is return on cost.
Yeah, my
right?
favorite. Yeah, because it is not, you really can't financially engineer it to make it seem higher than it actually is. It just kind of is what it is.
Yeah.
Where with like a levered IRR, right? Like if I say, okay, we're at a 33.19 now, and this is over, you can see it's over 36 months. So this is assuming you build it, stabilize it, sell it. I always look at a development deal on that metric, because I want to look at the return that we are getting for the risk that we are taking for the the pre-construction and then the vertical development. Okay, are we getting paid? And then the stabilization, are we getting paid for that? Like, are we getting the appropriate return? And then even if we plan to hold it 10 years, I'm always going to look at it on that 3 year to 4 year, depending on how big and long the build out is. I'm always looking at that, because to me, that's a good measure of risk and return. So I can change that to 120 months, right? We change that to 10 years. All of a sudden we're down at a 13.74 IRR, right? Because IRR is affected pretty dramatically with time.
Yep.
So that's why I always like to look at these as a build, stabilize, sell, no matter what our hold strategy is going to be. So then one of the other things that you have to put in here is, okay, when we sell this in 3 years, what's our cap rate going to be? I think that's more murky today than it's probably ever been before.
Right.
But you can see why, like, you have to look at IRR, but I don't get too focused on it, is if we drop that to a 4, all of a sudden we're at a 63% IRR, right? Which is nutty. But if you take it up to a 6.5, right? Which I don't think this asset would ever go there, but you never know.
Yeah, that'd be amazing when it trades for 6.5 cap for a new build over there.
Yeah. Well, all of a sudden you're at a negative IRR, right?
Yeah.
So that shows you the sensitivity of just changing one metric in here, right? Mm-hmm. All I'm changing is cap rate. I didn't change anything else, right? Change it to a 6 or at a 5.37. So, so realistically today, this is probably a 5 to 5.25 if I had to guess, just based on kind of what I'm hearing in the marketplace for our current assets. So, that's why I feel comfortable, maybe it's a 5, maybe it's, who knows what cap rates are going to be in 3 years, 4 years. We just don't know, right? It depends on what happens with interest rates and all those things here. So, so that's just kind of a little reason I don't focus too much on IRR. Mm-hmm. It is important, I think, a metric to look at, but the the untrended return on cost is really what I'm focused on. Mm-hmm. And the reason being is that is simply your property NOI divided by the total cost of the project.
Okay. So property NOI at stabilization?
At stabilization.
Okay, so NOI at stabilization.
NOI at stabilization divided by overall development cost of the project.
So basically everything. That whole development budget.
The whole development budget.
30 million or whatever?
Yep, you got it. Yep, you got that. Okay. So that's your return on cost. What we're doing is we are comparing that to current cap rates in the marketplace. So there has to be a spread between your return on cost versus where current cap rates are.
What's the current, I can't see on the screen, what's the current untrended return?
So we're at a 636.
636. Yep. So you want that above the current cap rates?
Yeah. So what we're looking for there is usually a minimum 100 basis point spread.
Okay.
Between current, return on cost and current cap rates. And essentially what that's telling you is, and I would say we're closer to probably like 130, 140 basis points here.
So a little buffer in there.
Yeah, so you want a buffer in there, just in case, because we're projecting a lot of things here, right? We're projecting rent, we're projecting expenses, we're projecting costs, right? There's a lot of unknowns, but and the reason you're looking for that also is a measure of the profit that you're getting for the risk that you're taking, right? So if we came out here and said current cap rates are 6.36%. Well, why in the hell would I ever go build something and take on that risk when I could go buy something
just
in
buy
today's
as
market
is.
for the same cap rate, right?
How much would that? And I doubt you can do it on the spreadsheet, but if you use the trended return on cost, like how much does that change the return on cost?
It'll go up.
Like, 100 basis points to...
probably not 100. I'd say, it takes a lot to move. It's funny, right? I feel like when you add costs, it's like exponential. And when you add revenue, it's like nothing. But at the end of the day, you're probably looking at another 30 to 40 basis points.
So I guess in some sense, that's just another like little buffer on there as well, because I think it's realistic to expect, hey, rents will be higher in a few years.
Yep, that's right.
Than today's. Okay,
that's right. Yep. So this is the main one, right? Because you can't really fudge the you can, but it's also going to affect your current cap rate too, right? So it kind of keeps all things equal here, and it's not looking at what is an exit cap in the future. We don't know. So it kind of takes unknown future stuff out of it, and it's really kind of a true measurement, right? And for any project that gets built and is stabilized, you can do that comparison right now. It's like, okay, well, we built this to a 6.8 return on cost, and current cap rates are 5. Like that worked.
Yeah.
And the wider that gap is, the more value that you've created by doing the development project. So those are the real, in my opinion, nuts and bolts of this, is really that, that measurement, right? So, there's a lot of other variables in here. So essentially how we've set this pro forma up is anything in blue can be edited. Anything in black, do not touch it because it is an equation of some sort and it will probably blow the model up.
Right.
Oh, we know that game.
Something we build, and you kind of have your summary here. So this is kind of your first page, and this is something that we use internally. And then, back to that investment memo, right? That investment memo is what we send out to raise capital. So it's got a lot of the property information, and then we've got certain high level, important financial return metrics that we will pull out of the model here and put in there. And then, depending on who the investor is, sometimes they will ask for the model, and we will send it. We feel really strong about being very transparent in what we do, that we're not hiding anything. Please come and try to tear this thing apart for us. Because the more eyes that see it, the more questions that we have, the better that we're going to become, and the more things we're thinking about. So so this page here is really just a summary page, and we use a lot of this. A lot of this page is what you're going to see in that model, in the investment memo. So then you go here, and this is kind of okay, if you have a land loan, and then you put your construction loan details in. And then this permanent financing details. This is if it's a longer term hold and you're going to refinance. You're putting those terms in here. This one, we're really only looking at it on a 3-year basis, so we don't have a refinance in this one. So this would not be. That's why you see the DSCR. It's not relevant. Not relevant for what we're looking at. And you get down here in the cost. So these are all your inputs. Essentially, at the end of the day, these are where your blues are your inputs. And these are all they come from what we're seeing currently in the marketplace. It's feedback, costs, our feedback that we're getting from our general contractor. So there's a lot of different folks that that have a part of the
coming
assumptions
up with
that
the
we're
inputs.
using.
Yeah.
Yep. And after you do it so many times, you kind of become become accustomed to it, and you kind of know, like, I could go do an underwriting in probably 30 minutes right now. just because I know the model well. If I have the information, it's a pretty quick exercise.
That sounds like a challenge for a future video. We're gonna send the Jeopardy music,
right.
give you a cup of coffee and a shot of whiskey, and start the clock.
That's right. So so like I said, this is really the nuts and bolts of it right here.
Yeah.
And then you can see these are kind of the project exit stuff, and you have cap rates, and you have, you look at this, your proceeds per unit might, seems pretty high. But for the product that we're building here for, and
for the
and the rents
location,
and the locations, doesn't scare me.
Who would be the buyer on this? Is this institutional or still?
It's a good question. And it was, I actually wouldn't have been able to answer this before building these other deals, because when we built 1250 South Pearly Aston, right across the highway, Platt Park, kind of our first project, trophy asset. We actually got pushback from equity investors on like, who's your buyer here? It's too small for an institution, but it's too big for a small guy.
Yep. What
our experience was the complete opposite. We had every small guy interested in buying the property that could get up to that level, and we had institutions knocking on our door. So at one point in time, we had 5 people, 5 groups that we were talking to, and it was a mix of institutions and private high net worth individuals that wanted to buy this property unsolicited. We hadn't listed it.
Really?
And so we.
And it was just a high net worth individual, not even like a syndication group.
Yeah,
just
it was like a really wealthy, really wealthy guy out of New York. I think we had another one out of California. We had a local group that was institutional. So we've had kind of everyone and anyone in between look at this, and I think that speaks to the qualitative nature of it.
Yeah.
And the quality of the location we built as well. So
what were those exit prices on those 2 other?
So we were just looking at one. We were actually under contract to sell it at TCO at a very large number. It was $582,000 a door, which it's a big number for a wood frame product. And ultimately, it was just kind of bad timing. Ultimately, they walked away from a large amount of earnest money. At the end of the day, they walked away 2 weeks before they're supposed to close. And it was kind of a result of we were a little late delivering the project, and then but more so it was kind of as we were going into these huge interest rate hikes, and I think there was unknown in the marketplace. They kind of missed their rents, in my opinion. They didn't hire the right group for the management on it. We ended up signing leases at 33% higher rental rates than what they were performing. But that was kind of the institutional mindset, right? Like I think it's hard for them to understand assets like this. Long story short, it ended up not trading, but I think it gave us the confidence. We own it. Some great debt on it now, and we're just we just hit 96% occupied. So we're just cash flowing the heck out of this thing right now.
Well, that's a great plan B.
Great.
Sit there and just take your rents.
Yeah. Yep. So we're using information that we learned there, to inform this and some of the exits and things like that. Our average unit size here is larger than across the street.
So this could go institutional or to.
It could go either way.
A high net worth buyer.
I could see it going either way. Yeah. Yep.
I mean, it makes sense for an institution if they're out there buying single family homes.
Right. Yeah. Yep. And
16 apartment buildings.
Yeah. And ultimately, Chris, like one of the things that we're thinking about as well is, okay, well, if we have one of these, maybe an institution is not invested, but if we have a whole portfolio of 10 of these buildings, right?
Oh yeah.
All of a sudden that's pretty appealing. So I think as we continue to grow our portfolio and continue to develop buildings like this, it's going to, the more we own, the more optionality that it's going to give us on the backside.
Cool. Adam, this has been fantastic. I know we went longer than we had planned for, but that is how these deep dives go.
And we didn't even go near as deep as
I know.
I wanted to go.
Spend another hour, but we're going to have you back and we'll talk more. So, listeners, views out there, if you guys have, certain topics or areas in here you want to know, let me and Matt know. We love talking about this. We're appreciative of your time, Adam.
Here as well to help answer any questions too.
Cool.
It's real estate, but it is a completely different aspect of real estate that is very specialized, I would say. And the only way to do it is the only way to get experience, to get good at it is just do it and learn it. And I was fortunate enough to learn on other people's dimes. So.
Yeah. And if you anyone that wants more details on learning how to underwrite these deals, let us know. I know a lot of people are saying, "Hey, can I invest in this? Can I 1031?" Let us know on there. We're working on some deals deals with you and Narrate, which is going to be a fantastic opportunity.
It's going to be awesome.
Yeah. Matt, thank you. Adam, thank you.
Thank you so
this
much.
was fun, and I look forward to doing a lot more of these.
Thanks, guys.
Thanks, everyone. Bye-bye.